Hello, everyone, and welcome to another Zoom analysis. Today, you voted for practicing trend lines, indicators, moving averages, support, and resistance lines. So today we will do that. Bart could explain theory. I could, in the meantime, drew what I think will happen. But again, everyone has a different opinion when it comes to technical analysis. Keep that in mind. My support will maybe not be your support, and trend line as well. So that's the thing about the technical analysis. Everyone seems to have their own view on the chart. So Bart, can you tell me any pair what you want to do? Doesn't, because we always do GJ and gold. Let's do another.
Well, use any pair you want, euro, US dollar, for example. I was just wondering, Jake and Sonia, did you vote for the technical analysis stuff or did you vote for something different?
Yeah, I did vote for technical, but again, I really wanted to vote for all.
Yeah, I voted for fundamentals, but I know other people wanted to learn some technical analysis. I had a few questions about Keynesian economics.
Sure. Leave it then for the end of the seminar and then I'll answer your question.
Okay, sounds good.
Okay, guys. So when we talk about technicals, we assume the following. There is something in markets called, if you have ever heard, efficient market hypothesis. Efficient market hypothesis was something very well known in academia and still is, which says that you can never actually beat the stock market index returns, which is incorrect. I actually talked about Jack Schwager about it. And he usually says it for the people who don't actively trade, because trading is extremely difficult from emotional perspective. It's also difficult from intellectual perspective. And it is best for people who don't know how to trade just to buy the stock market index and keep it that way. Because in the long run, in 30, 40 years, they will amass some significant amount of money that they will live happy, retired life.
You think I have a time for 4 years?
Well, it depends who I'm talking to. So I usually recommend people who are not interested that much in the financial markets, in the stock markets, just buy the stock market index and never ever trade. Some people made money on Bitcoin, on crypto wallets, and they think they are the kings of trading and investing. And these are the types of people that usually give all their money back to the market, because as you have already learned, being a successful trader or investor isn't that easy at all. So when we talk about analyzing the markets, traders usually use several ways. I would highly suggest to you to read the books by Jack Schwager, Market Wizards or Hedge Fund Market Wizards, in which he interviews the best traders in the world, and you can learn there what type of style are they using for trading. Okay, so we have usually two types of trading styles. I would say three, maybe four, but two basic styles. One is fundamental analysis, one is technical analysis. In technical analysis, you only look at the charts. You draw trend lines, you draw support resistant lines, you use indicators, you use markets patterns like head and shoulders. It all depends from your preference. And you use it to find an edge in the market, statistical edge. Usually the people that most often use this type of trading strategies are not people with economic background, but rather informatic or mathematic background. Okay, so technical analysis disregards fundamentals because they believe everything already known is priced in the market. And that, if you look at it, it does make sense. If you use moving average 50 on GBP, JPY, you know that price is in an uptrend. Some people, maybe they don't need to know why price is in an uptrend. We know why, because we have several times already said the differences in monetary policies, so we know the reason. But they are using moving average 50, and moving average 50 or 100, for example, tells them only look for longs. You see? Can you put moving average 50 on euro US dollar? So when we talk about technical analysis, we are assuming that everything is already priced in the market. And we are assuming, first of all, both fundamental and technical analysis assume that markets aren't efficient, that markets are really inefficient. Because if markets are efficient, nobody could beat the market. But there are a history of traders who destroyed the markets. One of them is Jesse Livermore in 1930s. You can read his autobiography, Reminiscences of a Stock Operator. He was actually the guy that went to become, I think, billionaire 3 times and then went broke. That's how his capital actually moved around. He traded stocks. So technical analysis uses technical tools to determine where the price is going to follow, because for technical analysis, price moves on the emotions of the people. Okay, so the emotions of the people make wave patterns that technical analysts use. So continuing further, when we head into technical analysis, we have several, I wouldn't say several, even hundreds of possible ways to trade the market. You can use daily time frame, weekly, monthly, hourly, 30-minute, 1 minute, 5-minute time frames, right? And there are several authors in technical analysis that use different trading strategies that they have back tested, and that gives them an edge over the market to actually trade the system. Some of them use moving average 50. Some of them use head and shoulders patterns, trend lines, okay? There are a lot of things that technical analysts can trade. You have probably heard of Elliott wave theory, Wyckoff method. These are all proven, and actually books were written about these trading styles that technical analysts use to get an edge over the market. Usually when we do technical analysis, we start with, actually, I don't use Elliott nor Wyckoff because they're somewhat subjective. And you should also remember that technical analysis is more of a subjective part of trading rather than objective. Fundamentals are mostly objective. Technicals are rather subjective because me and Maras will not draw the same trend line. Okay, you can have reason for and against a trade on any type of chart you want. Just change the time frame. So yeah, Maras now sees a channel, for example. I see it too, but he will probably not trade the channel. He will probably trade horizontal support. Can you draw also horizontal support and resistance lines?
Oh,
So regarding technical analysis,
which
we
one?
can start.
I have a couple of support.
Yeah, draw them all. Draw everything. You see, just draw it all, because to explain later to the people that being too much into technicals is not good. So when we look at the how we analyze that from the markets from technical perspective, we can use several of the following tools. There are indicators that are called trend indicators, right? These indicators are usually moving averages. Moving average 50, moving average 40, exponential moving average 20, 40, 50, doesn't matter. So it all depends about personal preference. Most of long-term traders use moving average 200 or 150, 100 to determine the direction of the price. And if price is above moving average, I don't know, 200, they look for longs. So these are market trend indicators, like moving averages. On the other hand, there are oscillators, which are best traded in the range. Oscillators tell us when the price is overbought and when it is oversold. Williams percentage R is an example of an oscillator. RSI is an example of an oscillator. Stochastic indicator is an example of an oscillator. So oscillator can tell you where you will most likely find sellers versus where you are most likely going to find buyers. Oscillators aren't usually that good in trend trading environment because they can be overbought for too long as prices continuing to move further up. So oscillators are better used in trading range. So here's a reward question. How do you know then when to trade a range, when to trade a trend? Because if we all knew what is a range and what is a trend, then you would just switch your strategies from oscillators to moving averages, right? The thing is, you can't know when the price has entered a range. You will usually know after some time price has been in the range. You will see that it is actually trading in the range. But the way we do it is we combine trend trading strategy and we combine oscillators to find our best possible entries to give us an edge over the market. Because to be successful in trading technical analysis, you need to have statistically proven edge. That's why I always tell you the strategies I gave you on ADX, the strategies I gave to Salman and to you on the stochastic and the moving average. You always need to backtest it, because there will come a time where the strategy will give you 5 losses in a row. And if you have backtested it on 500 trades, you know that in the long run, you will win. That's why it's so important to backtest any strategy you have. So you have a proven edge over the market. This edge gives you statistical advantage, and in the long run will make you money. Okay, so when we use analysis, we usually use stochastic or other oscillators, and then we use trend lines, not trend lines, sorry, moving averages. There are also these are systemic trades. What does it mean? You have indicators. So there is also one style of technical trading called price action, where you don't look at indicators at all. So price action, Maras does it every day on his live streams. Price action tells us where the price is most likely going to go. You use support and resistance lines, and that's just it. I use price action in my day trading as well. I just wait the closure above resistance, pull back, and then enter into my long positions. Okay, so this is Also another type of trading called price action trading. So in technical style of trading, you can trade ranges, you can trade trends, and you can use price action without any indicators. The most important thing is you need to find yourself. Some of you will be best traders at 5-minute or 15-minute charts. Some of you will have 1 hour charts, 1 hour time frame, sorry. Some of you will have 30-minute, 1 hour. It all depends about your personal preference and your trading psychology. That's why in trading, it's really important to know thyself, which strategy fits you the most. The strategy I gave you, ADX strategy, for example, last time, I don't like it to use it, not because it's not good. It's statistically proven to be successful when I backtest it, but I can't spend 12 hours a day waiting for a signal and looking at charts every 1 or 2, 3 hours, whether the price has touched the moving average and what happened with ADX. I prefer using macroeconomic strategies, for example, rather than waiting for my entry. Maybe I can make a bot so we can have signals that when the price has touched the moving average. But for now, it's not something I prefer from my psychological perspective. For you, you might prefer it. So people are different and they approach markets differently. That's why I suggest you reading the Market Wizards from Schwager, because you will see which of the traders he interviewed most suits you and your personality. This is really important. Some of us don't have the patience, while others do have patience. So we can have different styles of trading. Okay. So in technical analysis, I told you, you can use moving averages, oscillators. There is also one other indicators we can use, and these are called market breadth indicator that tells you what is happening with the market. You can use, Mars, can you open the S&P 500? Market breadth indicators what is happening beneath inside the market. For example, in the S&P 500 index, market breadth indicators tells us what is happening with the underlying stocks. One of these indicators, for example, that I use is advanced decline line. Can you open advanced decline line as an indicator? And also new high, new low indicator as well.
That's how called new high, new
Yeah,
low.
new high. Yeah, new high.
This one, or
I think it's okay there. So when we look at these two indicators, what are they actually telling us and how I use them? Advanced decline line tells me how many stocks in specific day advanced versus how many of them declined. And then I correlate it with what is happening within the stock market index. For example, stock market index could be going up on falling decline line. And I know this is not long-term sustainable. So market depth indicators tell us what is happening beneath the index, what is happening with components of the index. So we have better understanding where is most likely price going to go. Because if we look at the Dow Jones or NASDAQ, some of these stocks make 50% of the index, even though NASDAQ is composed, I'm not sure, I think it's of 100 stocks. Facebook, Meta, Apple, and these stocks make 50% of the value of the index. Okay, so advanced decline line tells me what is happening with stocks that are part of the index. And if I see US 500 going up while advanced decline line going down, I know that there will be a reversal. So they tell me market breadth indicators predict what is most likely going to happen in the future. Okay, now that we have had an introduction in technical analysis in the types of indicators, fundamental analysis also does not believe that markets are efficient, and they use and fundamental analysis is as I give you every day. They use fundamental macroeconomic knowledge on Keynesian economics, monetary policy, fiscal policy, interest rate differentials. They combine all the macroeconomic knowledge, current account deficits, to predict what is going to happen in the future. And then fundamentals, they look at cash flow statements from companies, for example, balance sheets. They use all of that, ratios. They use all of that to predict how much is a stock actually worth, where is the economy actually going, and then they trade into that direction. What I use for my long-term perspective, I use macroeconomic knowledge plus technicals, or fundamental knowledge plus technicals, to give me the best risk-reward ratios. And that's simply it. So fundamentals is more complex because you need to, I would argue that you can learn technical analysis in books in 3 to 4 months. Fundamental is quite a bit more complex than technical analysis because you have to understand the underlying movements of the trend. When something is correlated, when something is not correlated, you know that Maras, ask me, is gold correlated with GJ? Yeah, the answer is it can be and it doesn't have to be. And if you understand fundamentals, you know when it will be, when it will not be correlated. You see, as I told you numerous times, we have inflation team. We will not have inflation team in 2 years. So our fundamental approach will be different in 2 years than now. Okay. So fundamentals is more complex of a story. To learn fundamentals, you would have to really study the economy. I sent some books on introduction to economics, Samuelson's books. There are also books from Olivier Blancard about macroeconomics. But you really have to be a student and understand it, because to learn also macroeconomics, you need to understand how the aggregate demand, aggregate supply curves moves within these types of graphs. I suggested it, the subject, somebody voted for it. But yet, fundamentals and macroeconomics are way more complex. I use them because I see what is happening. You know, you feel like Neo from Matrix. You predict what is going to happen in the future, right? And you are most likely going to be right if you predict it really well. And what I really also love the most about the fundamentals is the fact that your predictions can be pretty accurate. You can pretty accurately predict what's going to happen. Or you can find, let's say, 95% possibility of winning the trade, because that will have to happen. Just like I told you, Erdogan will have to fight inflation, and he's raising interest rates. Everything as I predicted. We predicted GJ will have to go up, even though I know Jonathan was in the beginning of the group. GJ was ranging for 2 months, but I'm constantly being, no, it has to go up. It has to go up because fundamentals are like that. And in the long run, fundamentals always win and move the market. But sometimes, not sometimes, you can also manage a technical strategy that follows somewhat the fundamentals. As I said, the example of 50-period moving average. So without further ado, let's start with the trend lines. So Maras, can you explain how you draw your trend lines, support and resistance lines?
Can I ask you just a question about this Williams area sign stochastic? Which one do you found the best for you?
Well, it depends. It really depends. If I look at the
I
if
mean,
I
I know
look at
the
my
Williams,
trading strategy on bot, it's stochastic. When I used it on moving average 50, Williams percentage R was better. So it depends on the time frame, on the strategy I use. Both of them are good.
yeah, but they are pretty much the same, Williams and stochastic.
Well,
I
they
heard,
they were. I used 14.33, not 1.3. Well, I wouldn't agree with that. When I traded the strategy I gave to Salman, stochastic wasn't successful at all compared to Williams.
Okay, Jake, want to ask something?
yeah, I heard that one of them uses the lows for the formula and the other one uses the highs. I heard stochastic and Williams are like really similar. They just go off of, one goes off of the lows and the other goes off the highs.
Yeah, I don't know how they are actually calculated. I have read something, but I can't explain to you that thoroughly how they are made. But yeah, you can also use Bollinger Bands, for example. These are also good indicators to tell you where the market is going to go. There is something called in technical analysis mean reversion. So if prices move too far away from moving average, it is poised by mathematical formulas to come back sometime, right? And then some traders only look at these types of trades, looking back, price going back to the mean, to the moving average. One more thing that's important, which the mistake I made. I really learned a lot about technicals, and what happened was I got lost into analyzing everything. You see, from weekly time frame, you could say that this is a bearish flag pattern. You see how technicals can be, can mislead you. That's why when using technicals, you need to concentrate on one style. You can't look at trend lines, head and shoulders patterns, stochastic oscillators, Williams percentage error, Bollinger Bands, moving averages, moving average crossover at the same time. Pick your poison, okay? That's the thing with technical analysis. Pick your poison, something you're going to use. When I use my day trading strategy, I don't give a fuck about trend lines. You see, when I use my day trading strategy on 30-minute time frame, I draw my support and resistance lines, and that's it. I don't care about pivot points, moving averages, oscillators. I'm trading my price action strategy that has statistically proven edge. So if you want to use some kind of your strategy, develop it. Don't make it too complicated. People make trading too complicated. They use 50 indicators, 50 trend lines, I don't know, 50 moving averages, and then they lose because they haven't made strategy, right? Make something simple. The more simple it is, the better it will be. So Maras, could you please draw support and explain how you draw support resistance lines, trend lines, and Fibonacci?
Which time frame?
Whichever you choose, 1 hour. I would maybe choose 1 hour.
Okay, let's do 1 hour. Let's remove the drawings. This is the first thing I see. When you need to draw support and resistance, the first thing what seems to you more logical than just draw it, because probably it is correct. Don't try to complicate it. Don't try, I don't know what. Just do what you see and that's it. And this is the cleanest I could found, because buys, let's say for example, if you want to buy above this area, will be good buy opportunity because you have a clean candle from the left side, you know. So if you want to sell, you have a clean range from the left side. So everything looks great to me, and this is just pretty beautiful range, I can say. Now, if I want to complicate the stuff, I can also draw some kind of trend line and wait for price to retest my trend line. Okay, and yeah, this is the first thing what I see when I look at this chart, Euro USD. And this is how would I trade. I will wait for price to break above this resistance or below the support. Let's look at the 30-minute time frame, how this looks like. Yeah, this looks like a pretty strong resistance and so strong support, because I need to see at least 3 candles rejecting from the support or resistance, at least 3. Because if you have a 2 candles, that's only 1 candle closure. That's nothing. That's not so strong. But you have a 1, 2, 3 right there, and you have a 1, 2, 3, 4 right there. So then you know when the price finally managed to break above this resistance or below the support with the volume, it will be good sell opportunity. And that's it. That's it. That's pretty much it. On the 30-minute time frame, you also have a clean range. It's
Guys, do you know how to draw trend lines? I want to make sure.
yeah,
Sonia and
but
Jake.
because everyone has different. Your trend line is different than mine trend line. Yeah,
Well,
I
yeah,
mean,
can be, doesn't
concept
have
is
to
the
be.
same, but
Jake and Sonia, do you know how to draw a trend line?
Yeah, I do.
yeah, I mean, I don't know how much.
It takes me time to press unmute. Yeah, I believe I do as well, but yeah, I mean, as Mars said, everyone is a bit different.
Yeah.
Yeah.
Mars, could you draw maybe on some other pair or some other time frame?
Yeah, pick another pair. Just whatever. I'll do
Pick yourself. I don't know which pairs are there.
New Zealand Swiss franc. Okay, we never.
You can draw your trend lines and then I can draw mine.
Okay.
Usually trend lines are drawn whether on 2 or 3 touches. Some bigger technical experts tell the trend line needs to have 3 touches. When I draw a trend line, I use 2-touch trend lines. So trend lines are connecting the tops or the bottoms of swings positions. And usually I draw it from the bodies of the candles. Some traders draw it from wicks, connecting wicks only. So you see how this can be subjective. So my trend line and your trend line does not have to be the same.
Yeah, this is really good. Bad example because I have no idea what to look where to found the example where we can draw 2 with 2 touches and with 3 touches.
Yeah, it's not a good pair.
Because the only problem, let's do Australian dollar Japanese. Okay, this looks like okay. The only problem with 2 touches, because it's kind of tricky to me. Because we try to find another example with 2 touches. Let's go higher time frame. Yeah, this looks to me. This looks okay.
I would also draw another one from the low.
From this?
Yeah, to this. Not,
Yeah, I don't think.
there are 2 trend lines, 3 in my perspective. Yeah. May I draw mine?
Yeah, of course.
So the way I would draw mine is this AUD JPY. He drew correctly from my perspective the upper trend line. I would also draw a trend line like this. You see? Let me check it out. Here we have another movement. You see, when the price was within this range, I would also draw something like this, for example. You see how this was the range movement. See the price did touch, and then it touched again, created two trend lines, then almost touched the third time, broke above, practically retested, and then went up. So when you're using trend lines, it gives you some kind of a market direction, but you can see that they are mostly subjective. Me and Maras do not have to draw trend lines in a similar way, but usually, so when you draw a trend line, the main rule is connect the low to the low, okay? So two lows make a trend line. If there are three lows, the trend line is stronger. If this price actually came up to this point, this would be a way stronger trend line. So here's my rule. To draw a trend line, connect bodies of the candles, okay? At least two bodies have to be connected to draw a trend line. And that's how you draw trend lines. It's really simple. It gives you market trend, market direction, possible movements of markets. I usually use trend lines for my intraday trading strategy, as you have seen when I send a signal in the group. Here's also one possible trend line, right? You see, here it is. It turned out perfectly.
Yeah, maybe
Touch here.
maybe you can extend it to the right side.
Yeah, maybe I'm just looking. Touch here, touch here, touch here, practically touch here, almost touch here. See? So let's see, has it failed? It has failed.
In one put.
Yeah, it broke it, retested it, and then went line. So people who just looked at trend lines had the opportunity to earn money probably here, here, sell here, buy here, lose, retest, sell here, you see? So using trend lines is a good way to show you where the price is going to move. This is not the only way, of course, to make money, but this is how you use trend lines. So the rule for trend lines is, I will repeat, just let me give you my, give up remote control. So the rule of trend lines are connect tops of bodies of the candles. At least two touches have to be present to make a trend line. If there are three touches, even better. Okay, this is how you draw trend lines.
Yeah, but I have a question for you. Will you
Sure.
at which, when you look at this chart, do you consider this as a downtrend or the uptrend? Why will
No.
you
Well, only this part of the chart.
this part of the chart?
When you're asking me just technically,
Just technically, yeah.
if I were just to trade technical, I would shorten the trend line. I would consider it, yeah, I would consider it a downtrend. But if I look at the bigger picture, I think that's a bullish flag pattern.
Okay, if you look just like just this part.
If I look just this part, I would consider it a downtrend. Yes.
This is the 4-hour time frame. Yeah.
Yeah, I would consider it a downtrend. So this is how you draw trend lines. Can you now explain, for example, yeah, you could also draw that as well. Exactly. With the price within the channel.
I mean, you can find pretty much everything you wanna.
Yeah, guys, with technical analysis, you can see whatever you really want to see. So technical analysis can fool you. That's why you always backtest and try to find an edge over the market.
If I look,
okay,
if I look on the 1-hour time frame, yeah, this looks bullish. I will buy this trend line and see. If I look on the 4-hour time frame, okay, this swing is kind of bullish, and probably you want to trade with the swing, but also you have to keep in mind that you have a here possible rejection. So that doesn't mean the price will get rejected from this trend line, because okay, if let's say we drew this trend line, I don't see this trend line as a strong trend line because we have only two touches, like I say. This is the second one, and this is the first one. Because let's say, for example, if we had a closure, let's say right there, if this is the highs, then your trend line will be different. That's why I want to wait for, let's say, at least 3 touches. But this rejection is almost close. But yeah, everything depends. So yeah, Bart, you can continue.
Yeah, I got a question.
Yeah.
If the price went over that, if it breaks that trend line, would you consider it a change of trend? Then the one that you just deleted.
How this one?
Yeah.
Yeah, of course, of course.
I
Also,
actually sometimes use a trend line break strategy. Kind of like Bart's entries for breakout to the range and retests. I sometimes do those with trend lines. So if it were to break above and then come back and retest, I would sometimes enter along if it lined up with like a good Fibonacci level.
yeah, I sent on the trading view my view on the chart. This is example. This is a GJ.
Yep.
We had a 1 hour time frame. We had a breakout of this trend line. I mean, for now, if I want to buy right there, it's kind of too risky for me. You know, I want to see some kind of pullback before price continue going higher. And so let's play, and you can clearly see, okay, I was expecting retest not that day, but you can clearly see the next couple hours candle went down, and we can say that we had a retest of this trend line. And from that point, we had a rejection, price just went higher. This is the perfect example. So just like here, you want to wait for a breakout. If that happened, you want to wait for some kind of pullback and then enter buy. Because you can use this as a horizontal resistance. You wait for breakout, and you can actually buy with impulse entry. I'm not suggesting you taking impulse entry on a 4 hour time frame, but let's imagine this is a 30-minute time frame, and you can buy impulse entry. When you don't have to wait for a retest, you just enter and that's it. This is just like trend line is for me just like horizontal line, where you can, if you use 30-minute time frame, you can go impulse entry and expect the price will continue going higher. It doesn't matter if you have a, let's say, some kind of resistance area a couple pips away. If you trade trend lines, you could easily go with the impulse entry when price managed to break above this trend line.
Do you guys use Fibonacci's? Do you know how to draw a Fibonacci?
Yeah, I would actually I would use a Fibonacci together with that trend line for an entry.
Yeah, it's a good idea as well. Yeah.
I usually use the 0.618 level or the point 2.382.
Okay.
Yeah. There are possibilities you can use how to trade the. Just let me. So how to trade Fibonacci, but why is it subjective? When you look at the 1 hour chart, for example, Mara's zero trend line, he gave his example on that was a GJ, right? You can also use Fibonacci up from here to here, right? And you can see, did it touch your entries? You see there, yeah, it went to 0.5, almost 0.6. So for some traders, after this breakout, this was the entry, right? So it all depends of your style, right? So you can see the technical is somewhat subjective. Somebody will not draw this Fibonacci. Somebody will use a Fibonacci from here. And he'll say, it has 0.236. I'm waiting for 0.5 because it coincides with this horizontal support, and maybe it even coincides with this trend line, right? That's what I do when I use my day trading strategy. So Fibonacci, you already know how to use it. Just pull it from the swing low to the swing high and look at the areas you are interested in. I usually combine it with pivot points or with trend lines or with horizontal support and resistance lines. Why? Because this is where I think I will find most buyers or most sellers, because somebody is looking just at Fibonacci, somebody trend line, somebody horizontal support resistance, and they will react at that level, but I will react as well. And we will push the price higher into fundamental direction. That's my way of thinking. But this is how you also draw Fibonacci.
Let's say, for example, I wouldn't draw Fibonacci like this just because you have to from the lows to highs. But here you have I don't like this price action because this is not clear path to, it's because you have a here consolidation, then you have a spike up and you have I would say, downtrend little.
Yeah, I would say you're right, actually. Yeah.
So this is not price action as I consider that this could be low and this could be high, because I would only consider this one because this is, I would say, the clean uptrend.
Can you check it on 4 hour time frame? I'm just interested whether the 4 hour would apply to my style.
I want to see, I would say, clean.
Yeah, it wouldn't.
Clean uptrend.
Clean movement. Yeah.
A clean movement, something like that, just like we had yesterday on GJ, for example, right there. On 1 hour.
You have to start using it to start studying it, right? So yeah, this is here is a clean example. Exactly. You have a swing low, you have movement to the upside, price retested 61.8 and continued moving up. Maras waited for trend line. It didn't happen, but for someone else, price who used Fibonacci, this was a great entry.
Yeah, it did happen, but I don't expect so fast
I did. Okay.
because I
But-
watched on the 1 hour time frame. You can clearly see, okay, the next candle, I can even draw here. This is the 1 hour time frame.
Yeah, but it didn't directly touch the trend line, right? It was a
Yeah, because I was expected that price will, let's say, take a little bit longer to retest this trend line.
yeah, it doesn't matter.
It doesn't
Just
have to be,
for the
I
people.
would say, perfect, the retest. It could be a couple pips below or above. Doesn't matter.
Yeah, but let's use just for an example that people who waited for the touch of the trend line didn't enter, while people who waited for the 61.8 did enter. Somebody who waited for 0.382 got his stop loss hit. Okay, it all depends. That's why you use only one usually, right? You need to for the beginners, I usually advise you develop just one strategy, find an edge and just trade it, because you also have problems with emotional control, emotional trading, over risking, over trading. These are all the paths you have to undertake to become in the end successful, profitable trader. So we
had
have
a
a couple of
question.
lines. Yeah,
I was wondering if you ever use Fibonacci time zones or Fibonacci fans.
no, I don't.
Okay.
So we have covered trend lines. We have covered Fibonacci. So you know how to draw a trend line. You know how to draw Fibonacci. Draw it from swing low to swing high, and make it just like Mara said. Make it look clear. Like there is no in the meantime price movement ranging. You need to see clear swing, right? Clear upward movement of the price or downward movement of the price. Then we are left with indicators. So indicators, usually we can talk about divergences, but that I would suggest this should be an all other seminar that would have to last by itself only 30-40 minutes, only about MACD divergence, stochastic divergence, advanced decline line divergences. We already talked about it once. If needed, we will repeat it again. But you usually use indicators looking at them as an overbought or oversold situations in the market. So when the price is overbought, you look for sells. When the price is oversold, you look for buys. This is really simple. So can you, Mara, show, for example, one pair when we will look for overbought and oversold conditions? And usually when price closes below the overbought conditions, you enter a sell. So for example, we can check it at daily time frame. Okay, for Euro US dollar. So where would be if we were just look at Williams percentage R and R entries, where would we be looking for long, and where would we be looking for shorts?
If you use just the overbought and oversold area, it's right there.
There's also another one in between them.
Yeah. This looks
So
like
you see,
high.
yeah. So you see, guys, using indicators, you just look at what is the stochastic or any other indicator telling you. So you see that this indicator is above. When it moves from an overbought to oversold area, you enter sell. So here your entry would be somewhere around here. Your stop loss would be above. You would end up at a loss. Here you wait for indicator to close. It closed overbought, yeah, from oversold to range here, okay, on this one. And then you could have entered longs, stop loss below this point, and then going longs. On the other hand, looking at the daily charts, your long would have been here, stop loss below this candle, and you would have ridden the trend, okay? Let's further continue, maybe look at back. Entry short would be somewhere around here, you would lose this trade. Entry short would be somewhere around here, you would also lose this trade. Entry long would be somewhere around here.
You have
You
another
would
short.
sorry?
You have another short.
Yeah, I have, yeah, here. This is a short as well.
Yeah.
This would be a winner. Entry long would be somewhere around here. So the thing is, we can talk about it for an hour, but the thing is really simple. If you think it works, go back test it. And don't think just because it's simple, it won't work. It all depends. People overcomplicate stuff of trading. They overcomplicate. Go and try it and back test this and come to me with the result and say, yeah, I did it back test on 100 trades. It seems like 30% of them are winners with risk reward 3-1. I would be profitable if I use that trade. So when talking about indicators, you look at overbought and oversold conditions. Really, really simple. Are there any questions regarding indicators? So we have left with moving averages. Could you draw a moving average, let's say 50, 100, and 200? So moving averages usually tell us what is happening with the price, where the price is gonna move, right? And usually people use them because it's more easier than, for example, a trend line, because you will see that prices usually, if price is in a trend, you will see that all moving averages, bigger moving averages like 50, 150, 200 are in a perfect harmony with price action. And that's when you actually use them to trade in a trend direction. So yeah, let's check it out. How are let's say our moving averages fared out on Euro US dollar on daily chart? Could you go back more back? Okay, you can see a clear downtrend on the left hand side. You can see clearly how price, when it broke, this was one part of it where the price was ranging, but when it broke below, it just continued moving down. You can see how all the three moving averages just went down. Then price retested moving average 100, and this was just another short opportunity. Sometimes it retested moving average 50. So if you use just moving average 100, you would have one trade in a year. But if you use moving average 50 as your re-entry into short position, this could be, you could have just caught the lows, and continue trading. Now let's compare it to today's situation. Let's look at right-hand side. So you can see that moving average 50 is above moving average 100. Moving average 100 is above moving average 200. So we expect this to be uptrend, looking from the moving average perspective. So even if you don't know fundamental analysis, you know this should go up. And what are you now doing? You can wait for the price to retest the moving average 50. It has already done it one time. It also retested moving average 100. So your entries could be when this price retraces and touches your moving average 50, or if it touches your moving average 100. And these are your entries, right? These are also the type of entries for my macroeconomic view, because I know fundamentally I'm bullish. I would like to see price retrace more, maybe even touch these moving averages for me to re-enter, to scale into my long positions. But I'm combining fundamentals with technicals. But you can see how moving averages can also give you a clear picture where the price is going to go. Where moving averages are not helpful is when price is within some range and the price is choppy. That's when moving averages will not have such a clear downtrend or uptrend, but will rather have crossovers over each other very quickly. Could you just go back? There will certainly, we'll find some situation of it as well. Yeah, here's an example. You had just choppy market movement from October to October almost. 1 year of choppy market action where you couldn't use this strategy just because market was within a range. Market was not trending, and what you had moving averages crossing above each other, and also there wasn't a clear uptrend movement, right? That's where you would have actually lost money if you traded just moving averages. Could you go more back left on the left side? Let me check it out how it. Oh, here is a perfect example how it's also not so easily. Especially these movements on the 2020 when COVID happened, right?
Yeah, but we could say that we had some kind of
Yeah, we had the downtrend up until COVID somewhere. Yeah, up until that choppy price movement of COVID. But on the left-hand side, you had the downward movement. This was also a perfect example of downward trend, right? You have moving average. The best way to look at this, you have moving average 50 below 100, 100 below 200. This is logical, and they should all smoothly fall or smoothly go up. And you have it actually on this chart 2 or 3 times I showed you. At the end, we have an uptrend where they are looking smooth, not as smooth as when they were falling down. But could you go back on the right-hand side of the chart? So this was smoothly falling down, and now this looks like it is smoothly going up on the right, more right in the end. Yeah. So what we can now see, we can expect pullback before further bullish continuation. Okay. So look at it that each of the lower moving averages has to be above the higher moving average, and you can look for retracement to your moving average and then enter long position. Okay. So this is how moving averages are used.
Okay, I just
I'm sure you heard about strategies of moving average crossover, but Maras actually uses this on his trading bot, his strategy, right? And that's what Maras does, and he showed you already how to do it.
So in conclusion, you don't use moving averages if there is a side trend or no trend, right? You can use it only on a trend.
Yeah, if there is no trend, that's why people combine moving averages with oscillators, because oscillators can then save them within a trend. When there is no trend, you see, then the oscillators can give them entries, and they can be winning and losing. So when you have trend trading strategy, you are making money while the trend is happening. That's why I love fundamentals, because fundamentals give you a trend. And also, but when the market is within a range, then moving averages is not working that well. But then you need to have, okay, how can I protect myself when market is not in the range? And I usually do it by using oscillators if I'm using technical strategy.
I use exponential moving averages, EMAs.
Okay, that's good as well. Yeah.
Yeah, but I'm using them from a Fibonacci sequence, so mines are 89, 55, and 34. And then I also added 100 and 200.
Yeah, if they
So-
work for you, great.
Well, I mean, they work with the strategy that my previous teacher had,
Mhm.
but I was also looking for like another strategy. So I'm like in between right now, but I still have these EMAs.
Yeah,
I think we have covered most of the technical stuff.
yeah, I'm just looking now. Let's say if you wanna, if you use just the moving average 200 and 100, when the, for example, yellow line 100 is above, when price is above moving average 200, then you can wait for price to retest the moving average 100, and when that happens, you can enter buy or sell. For example, let's say here winning trade, here's a winning trade, here's a losing trade, then price is below, so you can look for sells. You could enter sell here, you lose, then you have buy here, you kind of win.
Yeah, I
And
wouldn't. You know why I wouldn't? Because the moving average 100 is above 200. I have to see them all in the direction.
Yeah, but here you
This
have
wouldn't be a
buys.
sell for me.
Buys.
Buys. Yeah, these are buys are possible. Yeah.
You have one touch, two touch, third touch.
Yeah, exactly.
Trend is changing. Then you have a one buy. You have here loss. Then you have another buy. So I mean, it's you can find anything what you want, to be honest.
Yeah, when you're using technicals, I could argue any point I want. I could even argue that this is a downtrend. Just open the monthly chart, right? That's why I love fundamentals. I could say, yo, you know what? This is we can see clear trend line on Euro US dollar from the high of the month, and we can see that price is soon going to touch it. Let me show you. That's why I love fundamentals, because nobody can screw me over with fundamentals. Let me give you an example. Here's the trend line. Yeah, well, may not be perfect, blah blah. But you know, this is a clear downtrend. Price will touch this trend line, it will fly down up to this support, right? I can say whatever I want. It all depends when you're using a technical analysis. That's why I don't believe gurus, and YouTube is full of them, that use only technical analysis to explain their positions, especially if they call out banks, manipulate the market. There are some evil people in the world just waiting to take your $200 account. Yeah, sure.
Okay, now we can go back to the questions.
Are there any questions regarding technicals? If not, are there any questions regarding fundamental analysis?
Yeah, you go ahead first.
I had a question about the Phillips curve. I know after stagflation in the 1970s, a lot of people made like modified versions of it, since stagflation kind of, a lot of people discredited the Phillips curve after it happened. But I was also kind of wondering if there's any difference in stagflation caused by supply shocks versus stagflation caused by like shitty like fiscal and monetary policies. And I feel like because I think I read that in the 1970s a lot of the stagflation was from oil prices volatility. And I've actually been reading from a couple sources that stagflation could happen in the near future. I was wondering kind of what you thought about that.
Yeah, so regarding Phillips curve, so Phillips was New Zealand economist, a Nobel Prize winner who developed Phillips curve in, I think it was 1955. I'm not sure. And what he did was he looked at the history of United Kingdom economic data, and he made the conclusion that the lower the interest rate of the central banks, the higher employment, meaning lower unemployment and higher pressure on inflation. Okay, it is completely logical. If everybody is employed in the economy, right? If all of us who now live in one country are employed, we will all spend more because we all have wages. If we spend more, we push prices up. Pretty simple and pretty logical. And then in as Milton Friedman predicted, Phillips curve broke because Bank of Federal Reserve actually printed money, expecting that unemployment will fall, but unemployment had stayed high with GDP falling down. Okay, with with inflation staying high. This is usually not the case. When people get fired, they reduce their spending, and when you reduce your spending, you put bearish pressure on prices, meaning you push inflation down. So this was the first time when actually there was a lot of doubt in Keynesian economics that dominated the economic theory from 1930s, from John Maynard Keynes, who introduced the Keynesian economics to put the Great Depression behind United States by increasing the fiscal and monetary stimulus, meaning spending. So what happened was Phillips curve broke down because of the supply shock. And Ben Bernanke wrote a great book of it on it called 21st Century Monetary Policy. Before, we didn't have such a supply shock. And that was, as Jake correctly said, that was the cause of stagflation. Stagflation was caused by supply shock because changes happen in the aggregate supply part of the curve. We can have a special seminar on aggregate demand, aggregate supply curve, which actually pushed the prices higher. Now, as the current situation is, we also had the supply shock, right? We had a situation where Russia affected the prices of natural gas and oil. And we had an increasing, now the same thing happened just like in 1970s and 80s. We had an increase in goods, meaning oil and natural gas, with the situation of high inflation. So, and then what the central banks did, they increased interest rates. They affected aggregate demand curve, right? They pushed down pressure on demand. And what happened is Europe, United States isn't currently in stagflation, but Europe is. If you look at Germany's economy, you have high core CPI and CPI, you have higher unemployment with sluggish GDP growth. This is definition of stagflation. So regarding your second part, this has already happened in Europe. And that's why, if you remember, for the last few months, I'm like puzzled that DAX hasn't fallen significantly, because this is a country, Germany is a country that has stagflation problems, high CPI, high core CPI, which is even worse. Unemployment it is still strong, but it is moving up, and GDP that is falling down, and DAX is moving higher. So this is fundamentally unsustainable. So I'm just waiting for a perfect opportunity to short the German stock market. Regarding United States, if Powell manages to succeed with raising interest rates from 0 to 5.5 to 6% without US economy entering into recession, I would call him the greatest central banker that ever lived, because he pushed down the inflation while US economy remains strong with low unemployment. He effectively avoided stagflation problems. And that's why when I talk why is the United States the greatest country in the world, because they are led by smarter people, right? Christine Lagarde doesn't know what she's doing. Bailey is an idiot, while Powell is way smarter than them. And this is what Powell is actually trying to do. Powell is trying to avoid stagflation because he's pretty aware of the aggregate supply shock. Aggregate supply shock is usually oil prices, while he's trying to reduce the aggregate demand to put bearish pressure on prices, whichever prices, bread, butter, doesn't matter.
Okay.
Any questions? Did you understand any questions regarding that?
Yeah, yeah, that makes sense. I was also wondering, so based on what you said about Europe being in stagflation, wouldn't that be bearish on the euro?
It's not. I wouldn't say it. You know why? Because even there are two scenarios. First of all, is if you have stagflation, that means that your prices are still going up or are pretty high. So if your prices are going up, okay, can you Maras open trading economics and open Germany's economy? If the prices are going up, you need to fight these prices. And Christine Lagarde is making the mistake of raising interest rates too slow. She already made that mistake. And to fight inflation, you raise interest rates, right? If you raise interest rate, your currency gets stronger. That's why euro will actually get stronger. This is the monetary part of the story. If you continue to raise interest rates, you are effectively more attractive because the interest rate on capital invested in Germany, in Germany's banks, will give you higher interest rate or higher yield than capital invested in Japan, right? That's why euro is gonna get stronger. On the other hand, you have United States that has decreased falling inflation. So they no longer have to be this hawkish, right? So in this current inflationary environment, euro will strengthen. If there was no inflation, If inflation was 2%, let's say if inflation in euro was 0.5%, while in United States was 3%. 4.5% isn't that high inflation as 7 or 8%. What could happen then, and I wouldn't be that sure on going long on euro, was that investors would fly from Europe, they would change their euros to dollars and then buy US stock markets. You see? So that's why euro could weaken, but this is not our current situation. On the other hand, then I wouldn't go long on euro, I would short DAX, I would short German stock market. I would position myself differently. For now, we are in a situation where Lagarde still has to be really hawkish, Bailey has to be even more hawkish, so we need to expect stronger euro and stronger British pound against the currencies that are not inflationary like Japanese yen. This is the safest bet. Also, now let's look at this example. If US economy enters into recession, right? What do you expect? What will the Federal Reserve do? Who can tell me with interest rates?
Can you repeat the question?
If US economy enters into recession, what will happen to the federal funds rate? Will it go up
They
or
would
down?
lower
Yes.
interest rates.
Yeah, interest rate will go lower. What does it mean for dollar?
Bearish pressure.
Yes, bearish pressure for dollar. Exactly. So then what would you be trading bullish then? You could trade gold bullish if that happens. You could trade stock market bearish. Okay. And you could also trade GBP, USD bullish because they have to fight inflation while the other are saving their economy. So you see how depending on macroeconomic perspective, you will position yourself differently. That's why we have these Zoom seminars. That's why I lead you and explain to you what is happening. But for you to be more sophisticated trader, you need to study more because you are missing great opportunities in the bond market, trading call and put options, right? Selling covered calls, selling put short put strategies. These are all examples where you can make money while the stock market is falling, and you can be pretty safe in that type of environment. So what I need you to do is study, learn, and we will cover it all. We will cover it all. This is not, people study economics for 4 years, right? You can't learn it in 2 months. But if you are really passionate about this topic or about this profession as I am, through time you will get the gist of it, right? So yeah, what I wanted to say, yeah, dollar would fall down, and then not only could you trade dollar down or stock market down or gold up, you could also at that moment trade the yield curve. And yield curve, that's why I'm talking about macroeconomics. Yield curve is, could you write yield curve on Google? It is a graph presenting the values of 2 to 30-year yields. And then what would happen if you can do it. So if, just let me now go back to the Google and just type yield curve and go to pictures. If Federal Reserve is going to reduce interest rate, that means open the, may I just take over, please?
Yeah.
Okay, here's a perfect example. So currently, yield curve is inverted in the US economy. Inverted yield curve usually signals recession, but not always. But it has most of the time been right, okay? That's why I'm very careful with long-term predictions. So what would happen? Now current interest rate is 5%. If we enter recession, Federal Reserve will reduce this yield curve, will reduce this interest rate. This yield curve will fall down, while this will move up. So how you could not only trade bearish dollar, because you have to trade bearish dollar against something, but Federal Reserve is going to reduce interest rates. This part of the yield, this part of the curve will fall down, and you can bet on that. You see, it's pretty normal, and it is more, how can I say it? It's more sure than trading 2 pairs, because if I trade USD Japanese yen, for example, both of them are affected by each other country's economies. Yield curve of the United States is affected only by its interest rates and time to maturity. And that's why you could have shorted this part of the yield curve, bet it to go down, and this part to go up, and for it to move back to normal. So there are a lot of ways you can actually trade the markets into fundamental direction. Any other questions?
Yeah, one of my questions was yield curve, so thank you for covering that. I just wanted to ask you if you would comment on last week news after the previous seminar that we had.
You mean
So-
on the last?
Yeah, so from the 19th to until yesterday. If you have any comments.
Well, we had earnings data, right?
Mhm.
Just let me open the Forex Factory. we had earnings data, and we had most of the data was actually extremely bullish, except for Thursday when two of the NASDAQ biggest companies, I'm not sure which one were they, actually had worse than expected data, and that's what moved the market. So as you saw in my analysis, I gave you long trade an analysis on US 30 to go long from Monday till Friday, something like that, which actually played out pretty well. Unfortunately, the price didn't touch my buy limits. They missed that. They missed them by a few pips. This is such an unfortunate, but yeah, it is what it is. So this was one fundamental factor that affected the market. Also, we had core retail sales on Tuesday, which were deflationary. We discussed that in the last seminar. Wednesday, we had housing starts, which fell, which was pro-inflationary. And then Thursday, unemployment claims came 228,000, which still shows, still shows that the U.S. economy is doing pretty good. Just let me check. The number of individuals who filed for unemployment insurance was actually lower than expected. That tells you that this is pretty strong U.S. economy. So these people, that the last of them went to claim unemployment, actually tells you that there is a lot of buying pressure in the U.S. economy, and that U.S. economy is still pretty strong. And this strong U.S. economy comes from strong labor market, because the more people, as I talked about 10 minutes ago, the more people are employed, the more bullish pressure there is on the prices, because you can buy, right? If you're employed, you can buy more. If you're unemployed, you will save your money. So what needs to happen for me to see slowing down of the U.S. economy is that the labor market has to fall, okay? Or the way you can get out of inflation another way is that U.S. economy is so strong that it increases the supply, meaning the production of goods, thus reducing pressure on inflation. I'm not sure that will happen, but from what I can say is we have strong U.S. economy with strong labor market. If we want to see bearish pressure on inflation, most likely this will happen through increased unemployment, okay? Because the more unemployed people, the less bullish pressure there will be on inflation.
Okay.
Any other questions?
Oh yeah, I had another question about the yield curve. So the yield curve is basically short-term bond yields versus long-term, right?
Yes.
So in a recession, the short-term bond yields would be a better buy than the long-term, right?
Just let me check it. Buying bonds, right? Because yields and bars are inversely correlated. Okay, because if bonds go up, their yields go down. So if we have a recession, we expect that the Federal Reserve will reduce interest rates. Usually, Federal Reserve affects only the short-term interest rate, meaning 2-3 year yields. Can you go back to the chart of yield curve? So that means that the interest rates on short-term bonds will fall. Thus, short-term bonds will be more expensive. Okay.
Okay, yeah. So the longer term bonds would be a better buy opportunity then.
Just let me check. Yeah, the longer-term bonds will give you higher yield. Yes, correct. Because when shit hits the fan, people flock to gold, safe haven currencies, and people flock to long-term bonds, because they usually the longer part of the interest rate yield curve, meaning 10 to 30 years, is affected mostly by fundamental macroeconomic factors, not by monetary policy. Monetary policy mostly affects short-term part of the yield curve. That's how they manipulate the interest rate. So if U.S. economy enters into recession, what yield curve usually moves to normal. Now, why is that? It moves to normal because then the markets say, okay, we enter the recession, Powell will reduce the interest rate. If he reduces interest rate, he will push the yield prices of short-term bonds lower, right? Yields will go lower. That means the bonds will go up. And you can see that into this normal, that's blue. So from red, we will see movement to the blue part of the yield curve. You see how this short-term red part, let me just take over again. You see how this short-term red part actually moved to become the blue part. This is one way to play the market, and that's how I would play the market. On the other hand, this part of inverted yield curve will move up, okay? The best way to trade it is from the short perspective. Why? Because short is affected only and 90% mostly by the Federal Reserve. This is affected by market expectations or by investors' expectation, what will happen in 10 to 20 years. Nobody can know that, right? It's this part of the yield curve is harder to trade. That's why I mostly trade this part of the yield curve. Now, think about it, we can go into even more details. Now, if I, as an investor, expect that short-term interest rate will fall, but if recession started, first, what I will do, I will run to the long-term 10-year bond market. If I go to the 10-year bonds or 30-year bonds because of safety, because in the long run, everything will probably be okay, that means that their yields will actually initially go up. Okay, initially go up, and then as the tide slows down, as the panic subsides, then it will be normal for me to expect higher yields, higher interest rates on my long-term investments than on my short-term investments, and that's what will actually be in the normal course of the yield curve. Why is this normal? Because it's more normal for me to expect 5% if I borrow you money for 10 years than if I borrow you money, the same amount of money for 2 years. You have something called inverted yield curve now, because think about it, 2-year yield, 2-year government bond gives you more interest rate than 10-year government bond. Which is more risk? Of course, that more risk is on 10-year government bond, because there is longer time passing. The longer time passes, the higher the risk. That's why it's called inverted, and it's not normal. So after, if we see recession, we'll see movement to the normal yield curve. Any other questions?
Hi, I wanted to ask you, when they say, when they're talking about interest rates, they have like two numbers. They say 5 to 5.25. So I don't know like why they're like those two numbers that they're using.
Because they usually, how they affect the market is when they decide for interest rate increase, they say to their accountants, I don't know what's their name, go and affect the stock market this and this way, go and buy this amount of bonds, sell this amount of bonds, and do it within this range, right? So this is not some specific number that has to be constantly on the run. It's a market number. So actually what Federal Reserve does, it affects the market by buying and selling. Okay, and so it has to be within the range, right? Not one specific number.
Okay, thank you.